with me now. Go with me now. I'm gonna take you down. Go with me now. I'm gonna show you how. Go with me now.
All right, welcome to day one of Unit 3. We're going to be learning about gross domestic product. And to start out with, if we look at this chart, it's showing how our GDP climbs over the years. But every once in a while, it have a little hiccup and it drops. Okay. The reason it dropped in this case in 2008 was because we had a recession. And one of the things you're going to learn today is that GDP is used to determine whether or not we're in a recession. And so let's move on to all that stuff. All right, so there's a lot of ways you can tell how the economy's doing. A lot of people think, well, you know what, there's not really a good way because there's so many different statistics that we look at. You know, there's inflation. Inflation's just how prices go up and down. Okay, then there's unemployment, which is just the percentage of the workforce that can't find a job. But we have this thing called GDP. GDP is a really good measure because it actually encompasses the other two to a degree. Okay, and so gross domestic product is the first thing we cover in this unit because it's probably the best way to actually determine the health of our economy. So we're actually embarking on what is known as macroeconomics today, which is really focused on the economy as a whole. So I know we've already defined it, but really it's the study of economy-wide issues. And we're gonna be discussing a term called aggregate. Aggregate just means you're taking parts and combining them into a whole. Okay? So that's really all that is referring to. So for example, instead of an individual's income, it's the whole country's income. Okay, that's what we mean by aggregate. So gross domestic product, this is the important part for today. This is the market value of all final goods and services legally produced within a nation's borders during a given year. Okay, now that definition has a lot of underlined words in it. So when we refer to a market value, that means something has to be sold. Okay, so it has to be sold at a particular price. Final goods is referring to the end purchaser of a good. Okay, lots of goods are sold and then they're resold. Okay, so it's the final good. Or services. Legally produced, so it doesn't include things that are illegal. And then it's within a nation's borders during a given year. Okay, so it's the value of the things we produce here in the United States legally for final purchase. That is exactly what gross domestic product is. Now, it's the market value of all final goods, so that means that we're going to add everything together. Okay? Now, next time we're going to be talking about real gross domestic product. And it's the exact same thing except we adjust it for inflation because, as you know, prices go up every year. And so if you really want to compare one year to another, you have to adjust for inflation. Now, another term for this is constant dollar GDP, meaning we're using the same value of a dollar over time. So it's constant. All right, so why is it that GDP allows us to judge the health of an economy? Well, you're going to learn this axiom, and that is that production equals income. So output is what we produce, income is what we receive for that production. So essentially, output equals income. Now, if you think of this just practically, if you look at wealthy countries around the world, they produce a lot of output. Okay, they make things. All right, and then if you look at poor countries, they don't make things. And so that's one way to remember that production equals income. Okay, here's another way. You've got a lemonade stand, and you make $5 worth of lemonade. So that's what you've produced. Well, do you think you'll sell it? There's a good chance you'll sell it. So when you do sell it, you get $5 in income. So the production equals the income. And that's how we're going to think of this. All right, so this is your rule. Output equals GDP, which is income. All right, so 3 uses of GDP data. This is why GDP can be useful. Okay, it allows us to actually measure our living standards. So And by the way, it's not perfect, so we'll look at some of its shortcomings, but it's one good way because you can use dollars as a measure of living standards. Because what can you use with your dollars? You can buy things, make your life more comfortable. Okay, so that's one thing. We will also use GDP data to measure economic growth. In coaching, we used to always say if you're not getting better, you're getting worse because you never stand still. So essentially, we can use the GDP data to see if we're getting better. Okay, and that's typically what we want to do. Okay. And lastly, what I had already mentioned is that you can use GDP data to determine whether an economy is experiencing recession or expansion. So it's similar to keeping score. All right, so as far as measuring living standards, we can look at GDP two ways. Total GDP just tells us the total amount of production that takes place in a country. All right, this isn't necessarily a good way to compare countries. All right. China's GDP is 10 trillion, USA's is 17 trillion. I guess with this one we would say, yeah, USA is richer, but how much richer is USA? Is it only $7 trillion richer? Or is there another way to look at this? And so that's where per capita GDP comes in. Per capita just means per person. Okay? So this is where we take the GDP and we divide it by the population of a country. So that's what will give us the average living standard in a nation. So for example, the average income in the US is around $50,000. Well, you can do a lot with $50,000, so that's a good measure of our living standards. Okay? So here's if we break down China and the USA by per capita, it looks a lot different. And this is kind of interesting. If you look at growth rates, China's GDP is growing faster than USA's. I've got a graphic of this in a second. So eventually, very likely within the next 25 years, maybe sooner, China's GDP overall is going to surpass the USA. However, if we divide that out by person, China's current per capita GDP is only $9,400, okay, versus USA's of $53,000. So when we divide it out by person, now we can compare the two countries, and we could easily say that USA's living standards are higher. In fact, they're probably more than 5 times higher. Okay, so it's kind of interesting. Here's some other living standards using GDP per capita. Okay, Poland is approximately 3 times richer per person than India, for example. That's how we would look at this. All right, here's one of those graphics I was telling you about. So if you look at the entire world GDP, it's about $80 trillion. That's what the entire world produces. If you give each country land mass equivalent to its share of that GDP, this is what it would look like. So the largest economy on earth is USA. Okay, number 2 though, right here, is China. And then number 3, I don't know, it kind of looks like it might be Japan, maybe it's Germany. It's hard to tell from the graph, from the map. But anyway, it's kind of interesting. You know, that's what the world looks like right now as far as wealth goes. But then let's look at growth rates. Okay, this one is land mass is given to each country based on its growth, like how much has GDP grown since the year 2000. And in this case, China is number 1. They have the fastest growth rate. Okay, so that's kind of interesting as well. What's really kind of interesting is Japan. Okay, it's one of the world's largest economies, but it's not growing. Okay, it's kind of stagnant. All right. So the next thing we're going to talk about is business cycles. So we're going to use that GDP data that we are going to calculate, and we're going to use it to determine what our business cycle is looking like. So let's define the business cycle. This is just the short-run fluctuations in economic activity. All right, so this is when we have recessions, expansions. Okay, so the expansion is when GDP is increasing. Okay, so during a period of time when the GDP is growing, we would say that's expansion. Okay, the end of an expansion is a peak, and then the economy begins to contract. The contraction is when we have a recession. And then the recession ends in a trough. That is the low point of GDP where it starts to pick back up again. So these are the 4 parts of a business cycle. Okay, let's talk a little more about them, because I've got a chart in your notes that will list the phase of the business cycle, and then a defining characteristic, and then secondary characteristics. Okay, so if we define expansion, it's the period of growth. That is where GDP is increasing. Okay, so the defining characteristic is that GDP is increasing. Now notice it's real GDP. Okay, we haven't learned a whole lot about real GDP yet, but to define what phase of the business cycle we are in, you have to use real GDP. All right. The secondary characteristics, or the things that typically come with an expansion, would be low unemployment, higher incomes. Okay, the Federal Reserve will begin to raise interest rates. You start to see inflation. Businesses begin to invest more for the future, building factories, things like that. So that's what's going on in an expansion. This is where we want to be. Okay, this is what we want. We want to be here. All right, but we can't always be there. And when the expansion ends, we call it a peak. So the defining characteristic is that real GDP reaches a high point. Okay. Also during the peak or this turning point, you'll see really low unemployment, and inflation is really starting to get scary. Okay, inflation's a bad thing. So that's the peak. Okay, think of this as a turning point. It's not like a specific length of time. Okay, it's just a turning point. Then we have the recession. This is when the economy begins to contract. Okay, so the defining characteristic now is real GDP is falling, and it has to fall for at least 2 quarters of a calendar year. Okay, so that's typically 6 months. So during a recession, unemployment will tend to go above 6%, incomes fall. Now the Federal Reserve is going to lower interest rates to help us out in the recession. You're typically going to see less investment because businesses are worried about the future. And a lot of times you'll see more crime, more social problems, more divorce, more alcoholism, more drug abuse, all of those things. So that is a recession, and the recession ends with the trough. And so the trough is where real GDP reaches a low point. Okay? So that's our 4 phases of the business cycle. They are all defined by what is happening to real GDP. Okay, so that is the key to all of them. Alright, so here's an actual business cycle, and we are going to label the peaks, troughs, etc. So let's say we have our first peak right here in 1981. At the end of a peak, you have a recession. So here we have a recession. The recession lasted about a year, maybe a little longer, and it ended in this trough. Okay? Then the economy expanded. Notice it slowed down a little bit here. It slowed down a little more here, but then it picked back up again. Then it slowed until right here. This is the next peak. And the peak began the next recession in 1990. So that is what an actual business cycle looks like. I know if you were to look at this on your own, a lot of people are seeing these points here as maybe the peak, but they're not, because GDP has to be lower on each side of the peak for it to be a peak. Okay? So there's our peak. There's our trough. Here's another peak. During that time is expansion. And between each expansion you have a recession. Alright, so let's talk about GDP now. So there's actually several ways to calculate what is going on with GDP. We're going to primarily use this method, which we'll talk about in a second. But it's basically where we add up all the spending in the economy on consumption. So that's when you and I buy things. On investment, which is when businesses buy capital equipment used in the production of goods. That's when the government buys things. So notice it's government purchases, okay? Not all government spending, just purchases. Then we have our exports, which add to GDP, and we subtract our imports. So if we add up the spending that takes place in the economy, that is one way to measure what is produced in the economy. Okay? So here are the other methods. So the first one we just talked about is called the expenditure approach. Okay, the expenditure approach is where we add up all the aggregate expenditure on all final goods and services produced during that year. And again, remember, it's within a nation's borders, legally produced final goods and services, and so on. All right, so let's pretend for a second that I buy a loaf of bread. Okay, that means the $2 that I spent on the bread is added to the consumption category of the expenditure approach for GDP. Okay, so keep that in mind because we're going to look at two other methods. Okay, the second one is the income approach. Okay, the income approach adds up all the income earned during the year by those who produce that same output. Now typically, there's a little more to it than this, but typically it's just rent, wages, these are incomes, interest, and profits. Okay, so let's pretend the $2 that I spent on bread allowed a grocery store to put some of the money towards its rent, maybe some of it towards wages, some of it towards the interest it has to pay for capital, and some of it for profits. Okay, so that all adds up to $2. Okay, again, this is from the purchase of a loaf of bread. Okay, and then the third method we have is called the value-added approach. This adds up the value added at each step of the production. So let's pretend for a second that a farmer produces wheat at a value of 25 cents. Okay, and he sells it to a miller who then converts the wheat into flour and sells the flour for 50 cents. So far so good. And then the miller sells the flour to the baker, and the baker converts the flour into bread and sells the bread to a grocery store for $1. Okay? And then finally, the grocery store sells the bread to me for $2. Now, if we look at the value added at each step of production, the farmer added 25 cents. Okay? The miller sold it for 50 cents, so he added 25 cents. And then the baker, he added 50 cents to what the miller did by selling it for $1. And then the grocery store added $1 to the value by selling it for $2. So if we add up the value added at each step of the production process, we get $2. So these three methods yield the exact same results. However, it's easier for us to use the expenditure approach, and that's what we're going to do. So for our purposes, GDP is calculated by just adding up all the spending that takes place in the economy. Alright, so how is it that we're able to do this? Alright, the federal government has a Bureau of Economic Analysis, and they're the ones who actually will calculate all of this. So they will add up all the consumption spending, okay, all the investment spending, all the government purchases, and the net exports that are produced within our economy. Okay, here's some actual GDP numbers from 2010. Okay, so you'll notice this is always the case, by the way, it's about 70% of our GDP is consumption spending. Okay, typically investment spending is around 20%. In 2010 we were just coming out of a recession, so there wasn't a lot of investment. Remember when we talked about the characteristics of a recession, there's less investment taking place. Okay, and then typically the government portion is maybe close to 20%, so that's about right. And then net exports is usually something a little smaller than that. So again, in a recession we're going to purchase fewer goods from other nations, and so that's why this negative 4% isn't higher. Okay, because it could be significantly higher, say around maybe, well, what do I got left, 10%? I don't know. My math may not add up, but that's okay. I think it is. Yeah, that's about right. Anyway, that's what it looked like in 2010. So let's talk in a little more detail what is actually counted for consumption. Okay, so this is the final purchase of goods and services by households. Oh, by the way, with the exception of new housing. Okay, that's going to be part of investment. Anyway, consumption spending is made up into basically three categories. Okay, we have durable goods, which are goods that we purchase that are expected to last longer than a year. Okay, and non-durable goods, which are goods that we tend to use up within a year. Okay, so food and toiletries, those are non-durables, and then of course cars, appliances, those would be durable goods. Now what it says here, these two bullet points, okay, subject to cyclical fluctuations. What that's referring to is during a recession, we will spend less on durable goods. Okay? But we're still going to buy the same amount of food and toothpaste and toilet paper in a recession. So that's why it's non-durable goods are not affected as much by cyclical fluctuations, which is referring to recessions. Okay? The third category is spending on services. Okay? So this is payments for non-tangible things that you buy but you can't hold. Okay? So when you get your car worked on, you go to the orthodontist, you hire an attorney. Okay, those are all consumption spending on services. And this is kind of interesting, but most of our spending is on services. Okay, and the reason for that is because as our society tends to pay people to do things for us because our time is valuable. So we don't produce our own goods and services as much as lower income societies. Now, what about taxes? This is an important concept in economics. You need to make the connection that higher taxes will lead to less consumption spending. Okay? Next, we have investment spending. Now, investment spending is made up of three categories as well. Okay? Typically, when we talk about investment, we're talking about what's called real investment, which is the purchase of capital equipment, buildings, factories used in the production of consumer or capital goods. Okay? It is not investing in stocks and bonds. That would be called financial investment, okay, which is none of this. Now, there's a second category called inventory investment. Okay? Inventory investment is referring to the goods and services that a business purchases for resale. Okay? So for example, business buys a bunch of spam. Yay! Okay? Tom Thumb buys tons of spam. If they don't sell it, okay, by the way, when they do sell it, it would be consumption spending. If they don't sell it, though, it is counted under the category of investment, okay? Because if something is produced, we are going to count it in our GDP, okay? So if it's produced, it gets counted, okay? Again, this is inventory investment. We're just kind of describing it. Okay, so here's an example. Tom Thumb buys a truckload of spam worth $25,000. They sell 15,000 of it to consumers. So that 15,000 is counted as consumption for GDP in 2016. Okay? The remaining 10,000 was still produced, therefore it still counts, but in this case we count it as investment spending. Okay? So here is that second category. It includes purchases by businesses that add to their inventories. Okay? And this could be anything. Okay? If they don't sell it, it gets counted as inventory investment. Okay? And then the third category of investment is housing investment. This is the part that is a little confusing because you would think new houses would be part of consumption spending, but it is not. Okay? So you just have to remember that. So there's your first, there's your second, there's your third type of investment spending. All right, the third category in GDP is government purchases. Now, this is all things the government buys or services they pay for. Okay? So it includes employee salaries like the police. Okay? It includes government purchases of goods like this aircraft carrier. and it includes projects that the government builds, like these roads. Okay? Here's what it does not count. It does not count transfer payments. Okay? Transfer payments are just payments from the government where they tax one group of people and then send that money to another group of people. So y'all are familiar with welfare spending, Social Security. Those are all considered transfer payments. Okay? When the government spends money in that way, it does not add to GDP. However, make note here, when households spend that money, it does enter GDP as part of consumption. Okay? So we just have to be careful how this money gets categorized. When the government spends it, it is not part of GDP. When I spend my welfare check, it does count. Okay? Here's an example of some government spending. So this was in my hometown of Allen. The school district built a $60 million stadium. That does add to GDP. Alright, so speaking of government, I wanted to let y'all be aware that most government spending does not add to GDP. Okay? It's actually more than 58% now. It's about 60% of all federal government spending is on transfer payments, and so that does not add to GDP. Alright, the last category of the expenditure approach for GDP is net exports. And to calculate this, you add exports and then subtract imports. Okay? So when Caterpillar makes this piece of equipment and sells it to somebody in Brazil, we add that to our GDP. But when we buy this BMW that was produced in Germany, we have to subtract that from our GDP. And those two things added together is our net exports. Okay? Now, a lot of people are going to say, and we've already learned a little bit about this, that negative net exports is a bad thing. Okay? When we have a trade deficit, it means we buy more from the world than the world buys from us. So here's a ship coming in from China, and those containers are all full of iPhones. Alright? Now, when we have more imports, it means we get more goods and services for people in this country. So imports actually improve our standard of living. Okay? And this is what people don't understand. Imports does still add to GDP. Okay? It's just it won't add as much to GDP as if you were to buy a domestically produced good. So here's an example. Okay? I know the iPhone doesn't cost $299 anymore, but that's okay. Alright? When we buy one, okay, our purchase of an iPhone is going to add $299 to our GDP for consumption. Let's pretend that Apple pays somebody in China to produce the phone, and so $100 of that cost is imported. So it still adds $199 to our GDP. Okay? So just remember that imported goods do still add a little bit to our GDP, but we always have to subtract the imported value. Okay? Alright, so here is GDP in 2012. Okay? Again, we'll have those similar percentages as before, but this is 2 years later than the last one we looked at. Okay, consumption spending is still close to 70%. Investment spending is up a little bit from what it was 2 years previously. Government is down a little bit. Export spending and import spending are about what they were. So let's talk about, this is the last part of our lesson today, and that is the 8 things that do not count in GDP. So remember the definition? The definition was basically the value of all final goods and services legally produced within a nation's borders during a given year. Well, there are 8 things that sort of come close to fitting that definition but don't quite. And so I wanted to specifically go over those things. Okay? So here's the first one, intermediate goods. So remember, it's final goods that count. Okay? So tires and batteries sometimes don't count because maybe Ford Motor Company is buying those batteries and those tires, and they put them in a car, and then you buy the car. So if they were counted when Ford bought them, and then they were counted again when you bought the car, then it would get counted twice. so we can't count intermediate goods. Another example, KFC buys chickens. Well, when KFC buys chickens, it doesn't count because that's an intermediate good. When you buy the chicken from KFC, then it counts. Okay? Here's an example of that. So if Kohl's is selling these designer tank tops, they're basically buying a shirt and then selling the shirt to you. And when you buy the shirt, it's $20. Okay, that's what gets added to GDP. But before you bought the shirt, there was a wholesale shirt wholesaler. There was a textile mill that did some production. There was a cotton farmer. Anyway, if you were to add the $1 that the farmer produced and then the $5 that the textile mill sold the cloth to the shirt manufacturer at, and the $12 that the shirt manufacturer sold it to Kohl's for, and then the $20 that you bought it for, it would add up to $38. And so that's why we can't count all of these intermediate goods. We only count the final good. Okay? Number 2 not counted, secondhand sales. Okay, in 1986, I bought this Cutlass Supreme. This was my first car. And you can see that picture is of me about to take a date to the Christmas dance. Lovely. I was 16 years old. Anyway, when I bought that car, it was used. It was already 6 years old. So when it was produced in 1980, it counted in GDP, so it can't count again. So you can only count things once, and that is in the year that is produced. Okay? However, I want to give you some caveats here. If, for example, the car dealer spent some money fixing the car before they sold it, the amount of money they spent fixing it would add to GDP because it is current production. Okay? Or, remember, income counts, so if a salesman earned a commission, his commission does count as GDP. Alright? So just be aware, the used value does not count, but any added value that was produced that year will count. Okay? Number 3 not counted, purely financial transactions. So anytime people buy stocks, bonds, put money in the bank, whatever, none of that counts. Okay? So, and the reason it doesn't is because buying stock is not buying something that was produced and manufactured. It is buying ownership in a company. Okay? So, no change in GDP when we buy stock. Alright, number 4, transfer payments. We already discussed this. Okay? So when the government sends money to people for doing nothing, as far as producing things, it does not count. Now, when people spend that money, then it can count. Okay? Number 5, unreported legal business activity. So this is actually a huge part of our economy. Okay, it's about I'm going to say close to $1 trillion a year, and it's things that people do for cash payments that they don't report. Okay, so for example, this girl just earned $100 babysitting. Is she going to report that? Probably not. Therefore, it won't get counted in GDP. Okay, sometimes waitresses don't report all their tips. And Saul Goodman definitely doesn't report all of his earnings for legal work. So these are just examples of legal activity that is not reported. Okay. Then we have illegal business activity.
The things I do for money.
Oh my God! They killed Kitty! You bastard!
Oh, no!
So this is the underground economy that is illegal. Whoa. Anyway, this is all activity that goes on in the world where money changes hands, production takes place, goods and services are bought and sold, but none of it adds to our GDP because it's all illegal. So remember, in our definition, it's legally produced goods and services that count. It's kind of interesting though. In Greece, in 2006, they began counting this for their GDP. And their GDP went up by 25% in 1 year. So it's crazy stuff. Alright, next we have non-market transactions. So in a lot of world economies, growing economies, or not really growing, but what we used to call third world countries, they're now called developing nations. A lot of a lot of work is done inside the home, and since there's no money that changes hands for that work, it doesn't add to their GDP. And a good example here is this housewife. Okay, she's doing tons of work in that house, but she's not getting paid. And since she's not getting paid, her work does not add to our GDP. So this could involve anything. It could be mowing your own yard, painting your house, doing your own repairs at home, repairing your own car. These are all valuable services that that are taking place, but since the economy is not demonstrating payment for it, then it doesn't count. Okay? And the last thing is something that we've already discussed, and that is U.S. corporations producing goods overseas. So Apple makes iPhones in China, and that production adds to China's GDP, but there is a concept called GNP, and that is called gross national product, and that just counts production that takes place by a country's citizens or capital. So in this case, Apple's production in China adds to United States gross national product, but it adds to China's gross domestic